Are you looking for a way to diversify your investment portfolio and protect it from the volatility of the stock market and real estate? Then consider investing in gold and silver. Thus, in this video, we'll explore the top 6 ways of investing in gold and silver and some of the risks and drawbacks. Let's get started. The first way to invest in gold and silver is through a gold and silver IRA. A regular IRA allows for saving money for retirement with tax advantages. However, normally you can only invest that money into stocks, bonds, and mutual funds within the account. But there is an IRA that allows you to allocate your investment in gold and silver. So, how does it work? When you decide to start investing in a gold and silver IRA account, what really happens is that you take some money from each paycheck to buy real gold and silver coins. Those get stored in a secure vault. The gold and silver coins that you own are now part of your IRA retirement account, so you get tax benefits as your coins hopefully grow in value over time. At around age 60, when you stop working, you can start taking money out of your IRA account filled with precious metals. One option is to have your vault send you some of the actual gold and silver coins you had purchased years ago. Those physical coins will deliver to you, and you can sell them online or to any jewelry store. Another choice is to leave the coins in the vault and have them sell everything for cash. The money from selling goes into your bank, which is easier than storing coins yourself. Normally, when you earn money from a job, you have to pay income tax each year on those wages. An IRA lets you avoid paying taxes now. So if you buy a gold coin inside your IRA using the salary you put into the account, you don't pay any tax now. Your money that went toward gold was pre-tax. Only when you start withdrawing the gold years later at retirement will you owe any income tax on those withdrawals. So you deferred paying taxes, and that helps your savings grow faster over the decades. Note that right now, the law only allows gold-silver to be held in individual retirement accounts. Most 401k retirement accounts at an employer do not offer the ability to buy physical precious metals as an investment option. You can buy stocks bonds only through your 401k retirement plan. The second way to invest in gold and silver is by holding gold and silver ETFs. When you invest in ETF with a company, this fund company actually buys large bars of physical gold and silver. These real gold-silver bars are then stored in secure vaults, and custodians are put in charge of safekeeping on the ETF's behalf. The sponsor then sells shares of the ETF to investors like you and me. For example, the company can buy a large 100-ounce gold bar. They put it in a vault. Then they divide this 100-ounce bar into 1-ounce portions. As investors, we buy shares in those 1-ounce portions of the bigger bar they bought, making it easy for beginners to invest in precious metals without having to buy and store them physically. It's a simple and convenient way to add gold and silver to your investment portfolio. The third way is to invest in gold and silver mutual funds. The way it works is the mutual fund company takes money from many individual investors like me and you, and then the company will manage the fund and use that money to buy shares of mining companies that dig for gold and silver. For example, they might buy stock in Barrick Gold Corporation. They also invest the money in things called futures contracts. These are like deals to buy gold-silver at some future date for a price fixed today. So gold-silver mutual fund shares represent owning part of that pool invested in mining companies and futures. But no real gold or silver is owned by investors. The physical metal bars are not held in storage vaults like with ETFs. The fourth way is to invest in gold-silver miner stocks. In contrast with precious metals mutual funds, where a portfolio manager picks and buys many stocks, ETFs, and futures to include in the fund. When you invest in gold to silver miner stocks, you actually buy stocks yourself on an exchange through a brokerage account, so you choose and own the stock yourself. You can invest in shares of companies that actively mine and produce gold and silver. It gives equity stake in gold-silver producers, so values follow metal prices. This is a riskier approach than physical metal. The fifth way to invest in physical bullion. This involves directly buying gold-silver bars, coins, or jewelry from a dealer and storing it yourself. Gives you direct ownership of real, tangible, precious metals. You take some cash and go to a local coin shop or jewelry store that sells gold and silver products. You can browse items like gold-silver coins, bars, and rounds in a display case until you find what you'd like to buy. For example, you select a 1 Oz American Gold Eagle coin and a 5 Oz silver bar. You pay the asking price to the dealer. If gold is $1,700 per ounce, the 1 Oz coin costs $1,700. Silver at $20 per ounce means $100 for a 5 Oz bar. After paying, the shopkeeper hands you the physical gold and silver products you just bought. You now directly own and possess them. You can keep the metal bars coins at your home in a safe place or pay to store them securely with a vault company. Since you bought actual precious metals, you can now sell or trade your gold-silver holdings. The sixth way is to invest in gold-silver futures and options. If you invest in futures and options gold and silver, you're actually betting on what gold or silver will be worth in the future. It's a way to make money if you guess right, but you can also lose money if things don't go as expected. Let's start with the futures. Imagine you agree to buy a certain amount of gold or silver in 3 months at a set price. If the price of gold or silver increases in those 3 months, you get it cheaper than the market price. But if the price goes down, you end up paying more than it's worth. For example, suppose you agree to buy 100 ounces of gold at $1,800 per ounce in 3 months, regardless of the market price at that time. Suppose in 3 months, gold is at $1,900 per ounce. You can buy it at $1,800, which is the contract price, and potentially sell immediately at $1,900, making a profit. Gold drops to $1,700. You're still obligated to buy at $1,800. Let's take a look at options. This is like getting a special ticket that lets you buy gold or silver at a specific price before a certain date. However, you must pay a non-refundable fee for this ticket, called premium. If the price of gold or silver moves how you hope, you can use your ticket to make a profit. But if things don't go as planned, the most you lose is the premium fees. For example, the call option gives you the right to buy gold at a set price, $1,800, within a specific period, 4 months. But you must pay something called a premium, a non-refundable fee, to get in this betting. If gold's price rises above your strike price, plus the premium, you can make a profit. If it doesn't rise enough, you don't exercise the option, and you lose the premium you paid for this opportunity. This is a sort of gambling that I don't recommend it. Finally, if you enjoyed this video and want to learn more about investing, personal finance, and other financial topics, subscribe to our channel and turn on notifications. Thanks for watching.